So if you're completely new to trading, you want to watch this video first. Get your pen and paper. This video is going to go through every single beginner thing they need to know. So if you're new to trading, almost brand new, fresh, and you're trying to start to learn how to trade, you want to watch this video because it's going to go through pretty much as a crash course, everything they need to know to actually get started. All the basic stuff, the entry level stuff before you start watching the more complicated things later on. But right now, get your pen and paper. Take as many notes as possible. If you have any questions, leave in the comments and I'll do my best to help. Enjoy the video and I'll see you guys in the next one. So when it comes to trading, all right, we kind of know what trading is. I would already assume for most of us out here, but the simple concept, if you're brand new to this, is that we are making money from the different price movements in the chart. So for example, if you're trying to go to Dubai today, I'm in London, there's going to be a price difference. The currency that we use, when you convert it, there's going to always be a difference. And this difference changes throughout the day, throughout, every minute, every hour, across days, weeks, and months. So the price that you're going to get today for £1 isn't what you're going to get next week. These little changes is what we make money from. Whether you're trading, Forex, futures, it's all the same idea. And these candlesticks here is what shows that generally when price is going up, then what that means in this sense, for example, we're looking at GBP USD. So this is pound and the dollar. When price is going up like this, on your chart, this could be green, or mine is blue, it's the same thing. As price is moving up like this, it means the value of pound is going higher, meaning dollar is going lower. So it's usually the currency that's in front, right? So whatever's in front, that's what that means generally. So for you to actually trade and make money, you're going to need, it's very simple to be fair. You need TradingView, which is this to analyze and see price movements, all those stuff. You're going to need that. Number two, you're going to need a phone, preferably a laptop, in my opinion. It's easier to enter trades, leave trades, because you're going to need something known as MetaTrader 5. This is very, very important. Without it, I don't use MetaTrader 4. I've never been a fan. So MT5 is what you're going to need. You're going to need TradingView and internet, of course. I'm sure everyone that has that already. So those are the key things you will need to trade. As long as you have those things, you can make money anywhere, at any point, at any time. And you will need some money, some capital, whether that's personal, whether that's prop firm. But personal is always going to be better, but there are prop firms these days, so that works too. Cool. And then another tool that you can then use complementary is things that will help you enter trades a lot quicker. Scalp, for example, and what that simply means is that I'm entering these trades on a smaller time frame, meaning the price changes on a smaller time frame, meaning as price is changing every minute, every 2 minutes, 3 minutes. That's how I'm making my money. Not really daily, not every 4 hours, a lot smaller. So entries need to be super precise. So you can use things like Magic Keys or any other softwares out there that will help you enter these trades a lot quicker. The quicker you can enter, the easier you can, the more consistent you can get the same entry, the better. So your results can be consistent, across the board. If you have any questions, drop them in the chat and I'll also be touching on them as we go. So those are kind of the basic stuff, right? That's kind of what you need to actually start trading. So in your own time, you can look into these, see how you set them up, etc. This is also in the A to Z. So you can also watch that afterwards if you haven't already. So that way you can set these stuff up. Well, it's pretty easy to set up. Now, the core concept of trading, basically, we have different aspects to it. So we'll start with time frames. I've kind of already touched on this slightly, but time frames, we have the 1 minute, 2, 3, 5, 15, etc. You can see all of those here. So these time frames are showing you the smaller movements within the big picture. So if I was to go to the daily, on the daily, the 1 day, for example, this is showing us what's happening. Every candle here is 1 day. So the black one is 1 day, 1 day, 1 day, another day, etc. So all of these are dailies, right? All of these are all dailies. But within the daily now, we can then go, zoom down even more and look at what's happening every 4 hours within that entire daily movement. And then we can go down to the 15, we can go down to the 5, 3, etc. So we're just seeing the smaller picture. Any time frame works technically to trade, but of course it takes longer the higher the time frame. For a whole day to pass by just for one candle, do you understand that's going to take time? But that's where time frames play a part. And then we have candlesticks. So candlesticks are these that we can see right here. In simple terms, when it's black, price reduced, price went down. When it's blue, price went up. In your case, it could be green and red. Same idea. Price is going up, price is going down. The price of GBP is going up or it's going down. You can make money both ways, either way. If price is going down, I get a question a lot of how do you make money when price is going down or things are going down? Just see the other way. When GBP is going down, it means USD is going up. So technically, you're simply buying USD at a lower price and then leaving when it's higher. If you were to look at it that way, it makes a bit more sense. Vice versa, right? If it's going up in this case, then you're buying GBP at a smaller price, and then when it goes up, you're leaving at a higher price. So obviously, you make profit on the difference, just as we know in terms of just general life, pricing models, right? So that's candlesticks in simple terms. There's a lot more that you might see on the internet regarding candlesticks and candlestick patterns and all that stuff. It's not what you need to know, so I'm not going to touch on it because, in my opinion, not really relevant. I don't trade that way. I couldn't care about really the patterns and stuff. So it doesn't really matter. So it's not something you need to dive into. These are just going to add extra stuff that you don't need to know. It's kind of a bit of a waste of time. So, okay, what's on to the next now. So we've touched on time frames. Now we have indicators right here. When you're on YouTube, most of us that first started, you will see a ton of indicators. I even have some that I've saved that I don't really dabble with. But indicators are kind of not instruments, tools that helps you to trade. It can help you to trade better. It can help you to be worse. Generally, I don't use any besides two. As you can see, there are these gray, right? This gray area here. This is just a session indicator. So if you were to go on indicators, just type in sessions. You might see a few, just use any, honestly, it's all the same idea. That just helps me to know, London session, boom. It helps me to backtest quicker as well. So if I wanted to go back in time, I can just see this is London, this is London. So I can easily just focus on price movement here, price movement here. So that's the session. Then the second is the EMA. So EMA as well as another. This is just averaging out price. So in other words, it's showing you the average of how prices moved in the past, X amount of candles. So in this case, let's say, I think this is the 100 at the moment. So the 100 EMA now is showing me price over the past 100 candles. So in the past 100 candles, at this point, what's price doing? When price is above the EMA, it simply means that you want to be looking for buys. When price is below, you want to be looking for sales. It's really that simple. When price is crossing over, sometimes it just means consolidating. There's nothing clean. So that's the pretty much the idea. So you can use 100, you can use the 50 EMA, some people use the 25, but obviously it's just to show you an average over a large sample size. So in other words, sometimes you can be on the 3 minute and then have an EMA of like the 200 EMA, so it's showing you the average of the past 200 candles. So you kind of get a bigger picture whilst being on the small time frame. So in this case, if I was to make the EMA 200, you will see that it moves up slightly. So in the past 200 candles, price has kind of just been consolidating. In the past 100, this is how it is. So it does change according to that. That's where the EMA plays a part. Besides that, nothing else is really, I don't really use any other indicators. The rest are just, some of them are just silly. Some of them people are trying to sell them to you to help you to do stuff. I mean, in some sense, you can use supply and demand indicators, but I'm not going to touch on that because that's something you use later on. I don't need to start with a bad habit now, rather start with a good habit from now. So you start learning how price action works. We're going to touch on price action probably next week. Depends. We'll see. Because when we start to get into the trading stuff, we need to spend a lot more time. Or we'll touch on it this week. We'll see. But you want to learn price action for yourself. You want to be good at it for yourself. That's super, super important. So, because I believe wherever you are in the world, you need to be able to trade and not depend on things doing it for you. Because what's the point in that? All right. Okay. Next, let's touch on, you will hear something known as pips. You wouldn't hear it much from me too much. But pips basically is just a term. It's a value that is used for movement in on the Forex chart in the market. It's not really relevant too much. Some people say they catch call 100 pips. It doesn't really matter because it all depends on your risk reward. You can catch 100 pips and that could be less than a one-to-one. So pips are not something to focus too much on, but just so you know what it means, it's just a measurement. The same way you have millimeters, pounds, you have, kg, etc. It's all the same. It's just a measurement of how much price has moved on the chart. That's what that is. But it's not super relevant. The only time you really need pips is when you're calculating lot size. So, for example, let's just say we were taking a buy from this demand and you wanted to enter this trade right here. And your stop loss being where if price goes past here, I want to get taken out of the trade. That's pretty much what your stop loss is. It is risk management and helping you to say, okay, when price goes past here, my trade idea is no longer really valid. So you can kind of scrap the idea. That is what that is. So in this case right here, you will see it says 8.3. 8.3 is your, I guess you could say pips, right? Is what's from this gray box to the end right here. So when you're calculating lot size, you can do this on different softwares, different apps. Just go on the Apple Store, type in lot size calculator, or go on the internet, type in lot size calculator. They will need that number, and then you just put 8.3 in. You tell them how much you're trading with, and it's going to tell you how much you should risk. That's really all that value is relevant for, to calculate your risk. So that takes us nicely into risk management. So when it comes to risk reward at this point, for that, what you need is this tool right here. How do you get this right here? This is very, very important. You go on to this tab right here on TradingView. TradingView, by the way, is, I believe it's free, or you can get a free trial, but eventually you're probably going to want to pay for it anyway, just to get more, backtesting features, etc. Very, very useful. But you will need your long tool. There's this stars here. You want to star them so that way it stays on your screen permanently. But you need your long tool when you're looking for buys and your short tool when you're looking for sells. So in this case now, let's say I'm looking for a 1, 2, 1. At this point, I know it's 8.3. So I'll put 8.3 on my lot size calculator. And when I do that, then in that case, I will get my risk and I will know exactly what to put in terms of lot size. So I can then put my lot size, click on buy, click on sell, etc. And voila. That's kind of how that works. Is this gonna be exactly, is the live content gonna exact is the live content gonna exactly as the 80 video what we watched? As in, if you mean live as in what we're doing now, yeah. So this is me. I'm gonna be going over everything anyway, right? Everything you need to know, but I'm doing it live. So it's also gonna be on the A to Z. So that is another way of looking at it, basically, for those who want the recorded version, etc. But here you're able to ask questions, blah blah blah, etc. So it's the same class, just more real time. There might be some stuff that is not in the A to Z that I might cover here, but you will not know that. You will know that unless you're here, if that makes sense. Right? So it's gonna be that plus more. All the little bits and bobs, all those tiny little gems, all the little secrets, the little pretty much everything that I do is what's gonna be in these classes. I'm gonna try and go for everything. But the idea is you're here, you're present, you can ask questions as well. And we can go through certain particular things that you might want me to go in more detail or that you didn't understand or that you're struggling with at the moment, etc. Hope that makes sense. But right now, it's important that I go through the beginning stuff just because there are some people that don't know the beginning stuff. So it's important for them. And at the end of this, there's going to be some homework as well. So do stay tuned for that. And these homeworks are going to be very, very important to your progress. If you don't do them, trust me, you're going to just fall behind and you're going to be one of those that are wasting time. So these are super, super essential. And we're going to go through them. Well, I'm going to go through them each week. So it's super important. So we'll get onto that later on anyway. But in the meantime, I've touched on pips, I've touched on risk management, how you calculate lot size, etc. These are all the foundational stuff that you need to know before you even start trading at all. Right? You need to know these stuff. It's the basics. All right. Cool. So now that we've covered all the basic stuff, let's touch on supply and demand. Right, let's touch on the exact way we trade. We're not going to touch on other strategies because, again, those are irrelevant. There's no point wasting your time with those. It's not going to make you money. So we're going to touch on what we actually do. What do we actually do on the chart each day? What is it that we look for? I'm going to do a kind of a brief overview real quick before we then dive into the basics and not the basics, the actual specifics. In simple terms, let's find a trade. Let's see. Okay. So supply and demand, right? What supply and demand is in everything in life, there's always going to be supply and there's always going to be demand. There's going to be people that are in need of something, and there's going to be people that are the ones supplying something. And this applies in everything, not just Forex. This is just life as it is. This is in the market, Amazon, whatever it is that you do. It's all there. So demand is when there is a lot of people who want something. Supply is when there is a lot of people selling something or wanting to give something away. The balance of this is what increases price, reduces price. If there's only one person, if I'm the only person in the world that has this iPhone, what phone is this? iPhone 16 Pro, right? And I'm the only person in the world that has it. If I'm trying to sell this, I'm able to negotiate a bunch of prices. I'm able to inflate the prices. I can start from $10 today, and next week this phone can be going for 1K because there's a lot of people who want it because I'm the only one that have it. Yeah. Looking at the other way around now with supply. There are 10 billion iPhones in the world, right? There's so much of it, but there's only two buyers. Now, those 10 billion people are going to compete and the prices are going to keep reducing, they're going to keep undercutting themselves because there's only two buyers and there's so much supply. So generally, price goes down when there's a supply. Demand is the other way. Price tend to go up when there's a lot of demand for something. And this is what price is doing throughout. And it tries to balance itself out. So it's going to be at one point, there'll be a lot of supply, a lot of demand. One point, there'll be nothing. And then a lot of supply, a lot of demand, etc. And it keeps going that way. How does this now translate onto the chart? On the chart now, we see supply as when price moves down in a particular direction, or down in general, actually, not particular direction. When price moves down aggressively and it creates gap in the market where price hasn't previously been to. That is what we see as supply. Demand is the other way around. So if we're looking at this example now, we will see, we already touched on price and how it moves. We'll see these black candles, right? Price is going down, price is going down. And we have wicks. So what wicks are basically is where price has been to, meaning that at one point price, let's say price was $10, 15, 20, 25. But at one point price decides to go from 25 straight to 50. It hasn't offered the price at 30, 35, 45 to buyers. It just shot straight from 25 to 50. At some point in time, price has to go back and offer those prices. It's just a must. It has to do it, right? So when that hasn't happened, we see a gap. We see a spot where the wick hasn't been to. So in this case now, we had a blue candle, meaning price went up, and then suddenly price started to shoot down. Boom. We had another price shoot down. Boom. And then we had another one where price shot down again. Boom. But there is this space right here where we see no wicks, right? There's no wicks to the right of this candle, and there is no wicks directly to the left. So there's this space right here where price hasn't been to yet. They haven't offered these prices yet, just as of now. Not these are relevant. You want to look at literally directly next to every candle to the right of it. So in this case, there's this space here. So that shows us, okay, there's some aggression. Boom, multiple candles. We have three black candles on the 3 minute. We have a fair value gap present. That's what that term is called. At this point in time now, we have a supply. And all we know now is at some point, for some reason, right here, price shot down aggressively. For some reason. We don't know the reason why. Sometimes it could be because of news. Sometimes the banks just do it. The reason doesn't really matter too much. But we know price shot down aggressively at this point. So this shows us at some point they did it. So we're just going to go with, okay, if they did it before, there's a small chance price is going to go back there and do it again. That is the trading basis. We see something happen before, so we just go with a small chance it's going to happen again. It's not going to happen every single time, but we have a general idea that it might happen again. So in this case, now price is going to go back up there. Price goes back up there. Remember, the wick shows where price has been to, but then it rejected all the way and closed down here. So this is a very good rejection. We can see the moment price went there again, people wanted to sell and continue to sell because it happened previously. So at this point in time, all we are doing is we are entering a sell and following what's happening. So we wait to enter here and we set our stop loss. Our stop loss being what is the point where we want to say if price goes past this way, then our trade is no longer going how we think, take us out of it, and we don't mind, losing whatever amount we put on the line. So at this point in time, we enter this trade now, and generally we look for 1 to 2. We try to double the amount that we put on. We try to. It doesn't always hit, but we try to. That's the general basis of things, right? So in this case, now we can see price that goes straight to the 2R. But as price goes straight to the 2R, there's different things you can do in between, but these we'll touch on as time goes on. But this is the general formula of what we do day in and day out. We wait to see supplies, we wait to see the months, and we just take them accordingly. Can you take a look on the supply you're showing at 8:45? Was it a good supply as well? 8:45 a.m. Looking at 8:45 a.m. Guessing you're speaking about this supply right here. I'm going to assume. So if we're looking at this example here now, let's close this. So we've seen that previous example. So when we're looking at this example here, we see a few things, right? First, we do have where price previously moved up and then starts shooting downwards aggressively. This is a very big candle as well. So this shows there is aggressive sales for sure. Definitely. Definitely. So at this point, what we're looking for is a few other confluences. We did break this small low, but we'll get onto market structure and stuff later on. There is also this little pullback. Yes, we close up below this as well, but then we can see that price gave us the entry right here because we have a confirmation that we used to enter. So overall, looking at this trade, it's not bad. To be fair, we do have the confluences that we look for those who know it already. It's not a bad trade at all. As we know, price isn't always going to win. It's just not going to happen. But why? There's something about this trade, right? I'm half taking this myself, to be fair, because it does look clean and I follow the confluences. But overall, the bad thing here is that it's not the cleanest pullback. We didn't get the cleanest pullbacks. I like to see price do this, right? Oh, not this. I like to see price do this, right? It needs to form these kind of ladders. But here, all we sort of see is just boom, 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 boom. Not really any pullback, and then we kind of get this. So realistically, it's just one straight movement. So that's why I I'm not really a fan of because we have another pullback, and price needs to pull back at some point. It just needs to pull back at some point. So if this isn't really a pullback, the pullback is coming, right? Price isn't just gonna just go straight down. It's not just gonna do this. Like it doesn't. It has to breathe. It goes up, it breathes a little bit, breathes a little bit. So I like to see price looking like this. But you can see in this case, that wasn't the case. So eventually price does breathe a little bit and then eventually starts to kind of do its thing. So you can even see we have another one right here, another supply right here now, right? So this is a much better setup that I would like because now you can see we did this, price breathed a little bit, continued, right? But this gave a small reaction. Price did react here. We react to the sellers, but it didn't hold. So these are cases where price just would not hold. And I'm guessing in this case, that's because price preferred this supply right here. Now that might raise the question, how do we know which one price prefers? How next time, how do we avoid this one and wait for price to go to this supply zone right here? Now the answer to that is you wouldn't know. There's no answer. You will never really know, right? That's just as simple as that. You won't know. You just got to pick and decide. Do you want to wait for this one? Sometimes what could then happen is price would go to this one and then go this way. And then you'll be annoyed next time because you'll say, oh, I should have taken this one. But then there'll be a case where price stops you out here and then decides to go to this one and then eventually drops as well. So you will never know. So ultimately, you just pick a system and you follow that system. In your case, do I take this one or do I wait until I take this one? In my case, I personally would just take the most recent one. I'm taking this one because statistically, overall price just respects the most recent. I'd rather go for the most recent, unless it's like super close together, etc. But you won't know that price is going to go to this. You just wouldn't really know. Yes, sometimes you can look at higher time frame. So if I go to the 15-minute now I can see this was a 15-minute supply and price wanted to stick with this 15-minute supply. So in that case, it's like, okay, fair enough. Price respected this 15-minute. But then you start to ask yourself, how do you know price is going to respect this 15-minute and now go to this 15-minute? So you see how if you start to look at different time frames, overanalyze, you're looking at everything, you're just going to end up giving yourself a bit of stress. Hence why you just kind of pick one because the next time price can go to this 15 and lose and respect the 5-minute or the 3-minute or the 2-minute. So in other words, every time frame has its days for winning. Every strategy has its days for winning, and it's not going to win every time. One day the 3-minute might be smoking. One day the 2-minute, the 1-minute might just be destroying the market, whilst the 15, the 1 hour are just, very horrible. It's just that you have to accept that, okay, today's not my day. Maybe tomorrow's going to be my day. Hope that makes sense. So that's kind of some psychology to it. How you should start thinking, bit of mindset change so you don't stress when you lose. Because some people lose here and then want to change things just because they took this loss. And then, there's just some things you can't change. It's just how it's going to be. So we've kind of touched now on kind of the overall system that we follow. All right, the overall basis, the simple systems. Is there any questions so far before we move on? Any questions? Don't be shy, especially ask now, because any PMs later on, I might not answer them. So it's just easier if you just ask now, because then I can go through it on the chart. But most of you guys should probably get this, this is the easy parts. Okay, cool. Let's continue. All right, now that we know the core foundation to things now, let's go through something I think is very important. So we have different time frames. How do you pick what time frame is for you? Right? You can trade the 1 minute, the 3-minute, the 15, the 16, the 20th minute, 1 hour, whatever the case is. But how do you know which one is for you, which one suits you the best? It's very simple. First of all, you need to first of all assess and understand that, okay, do I like to trade quickly? Do I don't like, or do I mind time just kind of doing this thing? That's question number one. Yes, everyone's going to say quick when you're kind of new to trading. You think quick is always better, but not necessarily. Let's go down to the 1 minute, for example. Looking at the 1 minute of this exact same day, you can see there's a whole lot more price action. Price has moved a ton. There's all sorts going on. Price shot up here, went all the way down here, shot up again, went up to this time, and then now it's forming lower lows this time. So a whole lot has happened. But if you look at the 15-minute of that same day, you will see not much has happened, right? In fact, this is the whole morning of that day. That's the entire morning. So you have to first of all know, can I cope? Can I read this price action easily? Is it stressing me? Am I getting overwhelmed? Especially if you're trading things like gold, sometimes this is happening super quick. So that's question number one is how can I keep up? Because things are going to be happening super fast. Now, two is what job do you do? If you work a 9 to 5, it's going to be very hard to trade things like the 1 minute. 1 minute requires you to be on the chart. You need to be looking at it at all times, right? You kind of need your eyes on the ball or you're going to miss it. Like the moment it hits the zone, you have 1 minute to calculate, to figure it out, boom, boom, boom. And that 1 minute is going to go incredibly quick. So if you're working, it might be tricky. So if you're working, you might prefer things like the 5 minute. Because in the 5 minute now, when price hits the zone, for example, right? So let's say this supply right here, when price hits the supply, for example, you have 5 whole minutes for this candle to do its thing before you enter. So 5 minutes is enough time for you to calculate, do your risk and all of that stuff, get ready, decide if you're going to take the trade. If you're panicking, you have 5 minutes to calm down and figure it out. That's a decent amount of time. But in 1 minute, it's going to be tricky. So things like your job, how you handle time pressure and all that stuff plays a part. But here's the cons to this as well. If you're trading the 5 minute, you might not find trades every day. If you're trading just 5 minute on GU, you might find 10, maybe even less in a month. Right? You might not find setups every time. Are you happy with that? That's the question to ask yourself. Ultimately, you can take 5 trades and still make good money. You can take, it's not about how many trades you take, it's about the quality of trades you take and secure that bag, right? But let's say you took 5 trades, right? You took 5 trades and you lost. Let's say you took 5 trades and you lost 3 of them. And that 3 trades took you 2 weeks to get, right? 2 weeks, you took 3 trades. React in the chat if that's going to stress you out or you think you'll be calm. Just leave any reaction in the chat. I also want to know. Put a thumbs up if you'll be calm, a thumbs down if you think your FOMO starts to kick in. You're going to start stressing a little bit. You're going to get a bit panicky. Maybe you're going to start chasing the next trade. You're looking for stuff. Stressed a bit. You'll be good. Stress. Okay. Okay. So that gives me an idea that most of us are kind of, 2 weeks is too long to just not find this out. Calm into the stress. So basically, bro, why this is important is just to see like where you are. Obviously, most of us, I'm guessing, are scalpers, because I am, meaning that if you're going 2 weeks without a trade, you're not used to it. It's very unfamiliar to you. So in other words, you need to find that sweet spot where you're finding trades, where you're not losing too many trades. So you have that balance where you're making money consistently. Otherwise, you might as well be a day trader. You might as well take like one trade, let it run, let it cook for a while. And then you can make 1 to 10s, etc. But if you're going to do that, you need to be happy to also, take 16 losses before you win 1 trade. So, so there's different parts to it. There's no one solution fits all. I'm guessing, but most of you guys are saying you'll be a bit worked up. So at that point, this is what you start to, this is how you kind of think to now start to decide for what do I prefer. So that immediately takes away something like the 15 minute. The 15 minute, for example, if we're looking at GU, let's say you found a trade this day, we can go back now. This is GU on this day, there's no trades. This is GU on this day, there's no trades. So I can just look at it very quick and see there's no trades. Right? This is GU on this day, there's no trades. GU on this day, there's no trades. So we're already gone a week with no setups. You do find a setup though on this day. So you see it's quality, right? You find quality trades. This isn't on NFP, so I wouldn't have taken this myself. So let's say you miss that day, and then you miss this day because there's no trade. So you can go 2 weeks, man, without finding a trade. So it gets a bit tricky. Gets quite tricky. And let's now say you went 2 weeks without finding a trade, and then you took this trade in the New York session, and then this trade loses. Now the stress starts to kick in. You waited 2 weeks, you found 1 trade, and that trade loses, you start to lose your mind a little bit, and you start to over risk. So that eliminates the 15 minute. So that takes us down to like the 5. 5, you might find a bit more trades now, etc. And then the 3, you find more. The 2, you find even more. The 1, you find even more. That's kind of how it goes. But that's not it. Now we have things like pot firms. Put a thumbs up in the chat if you trade pot firm. And don't react to it if you trade personal. And most of us on the pot firm sides or on the personal account at the moment. Okay, so we have one pot firm, sorry. Anyone else trade pot firms? Pot firm, okay. Both, nice. And everybody else? Okay, I'm gonna see maybe some people are having a nap. But why this is important now? Why time frames link to prop firms is because some prop firms, you need to know some prop firms do not like smaller time frames. Prop firms want to copy your trades if you're a profitable trader. But if you're trading the 1 minute, you will find that they don't like it because commissions gets crazy. It's hard to replicate. It moves too quick. So they don't like that. So that might limit your prop firm options right off the bat because now you can't trade those prop firms. So these are things to keep in mind. So now when you start to put all of these stuff together, you start to kind of fit yourself in certain categories. And this is how you know what time frame to trade. Why am I going through this? Yes, I could just tell you, boom, trade this time frame, boom, there you go. But this is important because the whole PACE protocol focuses on finding a system that suits your psychology. Meaning that if you need to trade the 5 minute and that's what works best for you, that's what allows you to trade a particular prop firm that you like, all those things like that, or your personal account, then you know how to utilize the 5 minute time frame with the system so you make money consistently. That's kind of that's what this is all about. Because ultimately, how we trade works on different time frames, right? We saw it on the 15. We can see on the 5 minute, we can see on the 2 minute, 1 minute, etc. It's just about, can I handle the losses that comes with it? Can I handle how quick it is? Can I handle that I might not be able to use 60% of prop firms because they just don't want me to trade with them? Can I handle the commissions that comes with it? Because if you trade on the 1 minute, there's going to be way more commissions. You're taking a lot more trades. Commission is going to eat a lot of that profit. So you have to be winning very often compared to a smaller, number of trades. So you don't have to worry about commissions that much because now, yeah, there's all these factors. Most of us don't think about commissions. But I'm telling you, when you trade things like the 1 minute, 2 minute, you take more trades, the commission is going to chop because commissions gets added whether you win or lose. So you could end up winning a lot of trades and then commissions just chopping a lot of those as well. And when you're losing, commissions just eat all of those as well. So you end up break even, right? Even though you should be in profit. So we've touched a lot on time frames now. We kind of get the idea. Overall, what time frame do most of us trade? Of course, this is going to be based on your back test. That's how you kind of figure out what time frame suits you. Back test, we're going to get onto that maybe like week 3. But what time frame are you currently using, or what time frame sounds good to you, or what time frame do you intend on testing? 2 minute only? One little tip as well, right, is that if you're somebody who wants to trade, let's say you like one pair very much and you don't like the rest. What you can do is use one pair or trade 2 time frames on that one pair. So for example, let's say GU, you can trade a 5 minute and 2 minute on GU, but you just want to stick to GU. But if you're going to have 5 pairs, then in that case, I recommend just one time frame because you don't want to be looking at 5 minute, 2 minute for 5 different pairs because now that's 10 different opportunities, more things to consider, more risk on the line, etc. Oh, that makes sense? Can you take a lot of can you take a lot of trades? Can you take a look at G today? Okay. Let's briefly look at G. So if we're looking at G on the 5, well, I'm going to start from the 15. Let's just see. So G on 15 today, London session, because that's what I trade. You can trade New York session as well, either way, whatever works for you. We're looking at London, GU15, we had this setup right here, right? So GU15, we had this setup right here. You would have been stopped out on this candle right here. You'd have been faked out on that candle right here, and then price goes to 101. Tough. But GU on the 5 minute now, we have nothing. No setups at all. I was not taking this in the 5 minutes, too old. And then we have another time frame that I use. We have G 3 minute. G on 3 minute today, we have nothing. So overall, I can see price action was only the best today. Yeah, on different pairs, in fact. We're looking at this today, nothing. This is at exactly 8 a.m. I usually like to give some time to cook. I wouldn't use, immediately after 8 a.m. I don't usually take those. So then we have GU 2 minute. GU on 2 minute now. What do I see? Boom, 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 boom. Consolidation at this point. Nothing's really happening. Nothing's really here. Nothing's really here. At this point, we do have this demand zone right here. But as but one thing I personally do is wait for price to fill the gap, as you might have seen. So on this trade, I wouldn't have taken it because price didn't wait to fill the gap. And then price is going up, up, up. We've got nothing. So overall, we've got nothing at all. You said you took a buy at 8.36, and that is at somewhere here, but definitely everything here would not have done. Any sort of buys at this point would not have taken because there is no buys at all. There's no setups at all. There's no setups at all. This isn't a demand. There's nothing at all. Why isn't it a setup? Because there's just no setup. Can't tell you why there isn't one because there just isn't one. So that's where the skill of looking and seeing and knowing what is a demand. There is no demand. What is a demand? A demand is when you have aggressive buys, right? You have a fair value gap present, right? There is no aggressive buys. There's two blue candles right here. D back testing from 8.34. Okay. At 8.34, this is the only valid setup that is there. There's nothing else. So if you're looking at this is wrong. If you're looking at this now, this is correct. This is a buy, right? Yeah, you're saying one more candle, but you didn't wait for the fair value gap to form, right? There is no fair value gap. You didn't wait for it to form. Where is the fair value gap? Between this and this? It can't be. Okay, so you're telling me it did, right? By all means, go ahead. But I'm telling you this is incorrect. So you're either going to take it or you go along with what you think is correct that lost you the trade anyway. But this is not a valid demand. This is a valid demand. So what you do is wait for this. You wait for price to come to this demand zone. And when price doesn't come to the demand zone, take no trades. We have a gap? No, we don't have a gap. That's what I'm trying to tell you. There is no valid gap from the demand zone, brother. This is the demand zone, or well, this would have been the demand zone if there was a gap after it. There is no gap after it because you didn't wait for the gap to form. You just saw two blue candles with a gap and said it's a demand. There's a difference. It's not the same thing. So you wait for price to get to this. But I'm going to go into kind of supply and demand a lot. One example, so you understand the difference between what's actually correct and what's incorrect. But this isn't a correct one. This is a correct one, but price didn't get to it, so you don't take it up. So overall, on the 2 minute, there would have been nothing. And then if we look at the 1 minute now, boom, 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 boom. In the 1 minute, we do have this setup right here. So on the 1 minute, you would have taken, well, theoretically, you would have taken this, but I'm telling you now, the stop loss with a 1 pip stop would have been tricky on many brokers. Many brokers and prop firms wouldn't accept this, or it wouldn't go through, or spreads are going to kill you, or something's going to go wrong. But realistically, you did get 2R, but in theory, realistically, this probably might have messed up and somehow you'd have lost this trade. Regarding the question you asked regarding the trade that you took as a bad trade, I'm going to go through in another video. I mean, no video. I'm going to go through it, when I'm diving more into supply and demand, be there, just so we follow the order of things, right? Otherwise, we're just going to get stuck in on one trade and it's not going to make sense. So, okay. So we've done a few trade reviews at this point. We've kind of gone through the beginner basic stuff. So now let's move on. Now let's touch on sessions. You hear a lot about London session, New York session, Asia session. Those are the main three anyway. Regarding sessions, I trade London session. This is simply from 8 a.m. BST to technically 4 p.m. But I like to say 12, I just like to trade to 12 p.m. because that's enough time without me being on the charts for too long. After 12 to 4, that's when it overlaps with New York session. But so after this gray box right here, now we're kind of into New York. New York starts at 1, but you can trade from pre-London, meaning from 12. The difference realistically is nothing. At the end of the day, price is doing its thing, but generally you will see that during New York session number one, there's a lot more news. How do you find out when there is news? Go on forexfactory.com. That's going to help you a lot. Anything that you see with a red folder, avoid being in the trade at that time because price is going to go crazy. It's as simple as that. And in New York, generally, the pip size of trade is a lot more volume, is usually larger. Well, it's all proportional anyway, but it's larger. Price moves a lot more crazy. There's a lot more volume in New York, but you might not find too many trades just because, again, there's usually news. So you have to kind of be careful of when you're trading. But overall, you can see GE, what's this today? This is GE New York session, all right? Starting from here, moved all the way down here, and now here's where we are. And then London session is usually a bit more peaceful. There's not that many news. The price kind of moves, you know, smoothly. Generally, you'll find that when price goes up in London, New York session or goes down. This isn't like a guaranteed thing that's going to happen every time. But when price goes up in London, generally might go down in New York, vice versa. That's kind of sessions. Sessions, you just pick a time when you're free, realistically. Some people work night shifts, so you might want to trade London, New York, just up to you. But New York session is from 12 to, I would say you want to trade from 12 to 4 max. Anything past that, volume starts to go down. Price doesn't move as it should. And New York session starts from about 11 till midnight, or let's say midnight till, like 6, 7 a.m. That's Asia session. Sorry. So that's midnight, Asia session. So that's sessions. We've touched on sessions now. All of these stuff I'm going through it, quickly. So if you want to, just so you get it, and then you can do more research on it if you need to, but that's kind of the overview on these stuff, so you at least get an idea. What's the last time you would enter a trade if you were trading in London? 12. So I like to just stop at 12. As soon as the clock's 12, I'm done. As soon as it hits 12, if there isn't a trade happening already, meaning that price is tapped into a zone, I'm not waiting for anything else. So I trade for exactly 4 hours and we just leave it there. As soon as I'm trading after 12, now I'm trading New York session, and that's the whole, New York session kind of stuff. Cool, cool. Now let's touch on to pairs. We have different pairs, GBP, USD, all sorts. We have many, many, many pairs that you can potentially trade. Gold, which is XAUSD, DAX, which is one I've been trading, which is, the 30 euros. There's many combinations. Whatever country you think you want to trade the currency pair, just look it up. You will probably find it. The idea to pairs is simply, I would say, to know what pair you want to trade, just look at it's kind of preference, but it's based on data a lot. So, for example, GBP USD, you have £1 pair, and USD being a New York pair, let's put it that way. So, pound would generally move better during London session, and New York session would generally move better with USDs. USD, Canadians, all that US related stuff, that's New York. But because we have both, technically GBP/USD trades well throughout London and New York session. Sometimes you have euros, sometimes you have other pairs. So you need to kind of trade a particular pair based on the session. That's why, for example, we have NAS 100. Yes, you can trade NAS 100 during London, but it performs better during New York session because NAS is the, top 100 companies in New York. I mean, in America. So generally, it's gonna move better when the US market opens and starts trading. There's more volume that way, and then all sorts. So when it comes to pair, number one, the session. Two, backtest these pairs. Backtesting, we're going to dive into a lot more, but this is just when you go back in time and see how this trade's perform. So for example, I can go all the way back to, let's just say, boom, boom, boom. Click on the replay right here, random bar, and now that's going to take us to 2022, December 23rd. So at this point in time now, I'm going to see, okay, cool. How, How did London session perform? Is there any trades that I could have taken, etc., etc. So in London session, you can see we didn't have much. In New York session, price started to go crazy. There was news right here, and we didn't have much. So then you can kind of go back in time and just keep seeing how price would move. That's what backtesting is. You want to backtest these pairs, and then you go with whatever you think is best that suits you based on the win rate. Some people prefer pairs that win a lot. Some people prefer pairs that gives them high RR, etc. So that's how you figure out pairs. All right. That's how you figure out the pairs that you prefer, and you just go with it. Again, everything is versatile. You can make money with everything. It's just about picking what suits your psychology the best. And then you go with it. You do have to put in some work, put in some hours to figure that out. But once you have your right pair, you have the right session, the right risk, then you can start focusing on trading. But that's pairs. Okay. So kind of gone over most of the basic stuff. I'm gonna set some homework now. Right. That's gonna lead us smoothly on to the next. So next week, we're gonna now go into market structure. We're going to go deep into market structure. We're going to look at several examples. Why? Because market structure seems to be the thing most people struggle with. But you need to understand market structure because knowing the direction that market is going in is going to help you to realistically win most trades. Right? If you get a direction wrong, you're always going to get right every time. But if you get right, then that's what's going to be winning your money. So you need to know when to, place a buy, when price is going to go down, etc., etc. So here's the homework. Here's what we need to do. So this week, I need all of you to pretty much go onto the chart. So go into the chart, and I need you to find different supply and demands. So for example, high probability supply and demand. So for example, right here, you're gonna mark up this supply zone. You're gonna put an arrow telling me, cool, you're looking for sales. They don't have to win or lose. It doesn't matter. You don't have to just find the ones that win. Doesn't matter if you get wrong. But the idea is to find a supply and demand and let me know the direction. So once you put like A, so let's say for example, in this case, like this, right? Like this. Let's say just a few candles. You want to take a screenshot. So you take a screenshot. In this case on a Mac, is Command Shift S, take a screenshot, and then send it over to me. Email it to me, a.sultanbusiness@gmail.com. Email it to me. You want to do 5 of these. 5 of these, send it over, and then we're going to look at all of these in real time tomorrow. I mean, not tomorrow, next week. That's very important. It's very, very important. Like I say, it's very important that you do these. And it's going to be homework every single week. And this is for me to see where you guys are at, if you even understand the basics, if I need to go into more detail, etc. Does that make sense? Otherwise, if you just keep quiet and I have no idea, then I can't really tell if you're lacking behind, if you even get it, if you're struggling, if how things are. I'm not gonna know. So let me see, is email better or this Discord better? So email it to me because there's some spam in Discord and stuff. So I'll put my email in the chat. Put my email in the chat already. So save that and then email it to me. Just email me 5 examples, take a screenshot nicely. It should look like this. So it shouldn't be messy. It should look like this, for example, right? Boom, this is a supply. There's an arrow saying you're looking for sales and you just take a screenshot. You do this 5 different times and send it over. Cool? Cool. Okay. So I'm going to look at one more trade since, can you look at, you took a trade today at 1808. Okay. This will be the last thing I'll cover for today. 1108 today. To be fair, I already said there was no trades today. So whatever is happening at 1108 is probably going to be invalid for sure. So okay, actually, maybe not. Let me see. Okay, maybe not actually. Hold up. Hold on now. So you have this. Boom. So this is a very good demand zone, actually. Very good demand zone. We broke highs, etc. Boom, 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 boom. First of all, I'll be waiting for price to fill it. Fair value gap. Do they fill the fair value gap? Boom, 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 boom. No. So it's as simple as that. So in my case, I would not take it a trade because it didn't fill the fair value gap. But for those who didn't wait, then at that point in time, all you're doing is soon as price gets in, you're waiting for the break. The stop loss is going to be below. And then, voila, 1 to 1, boom. At this point, you remove break even, etc., whatever the case is. If you didn't go to break even, you lost a trade. It's as simple as that. That's the idea for the trade. So in my case, here is what I would have done. I would personally be waiting. In fact, in my case, I wouldn't have taken this trade at all. Why? Because we are coming off a demand zone, and I don't like taking a trade that was coming off a previously winning trade. So I'm not taking a trade at all. I'll happily stay out and wait for the next one. Do I advise for price to wait to be filled? It depends on your psychology. They both win. You can wait for price to not fill it, and you will win some trades. You can wait for price to fill it, and you'll win some trades. Sometimes you will lose as well. Personally, what am I doing? I'm waiting for price to be filled just so I get less fake outs because I put my stop loss really, really close to the candle. So in that way, I'm giving myself the best chance. I don't want them to fake me out, come back, fill the gap, and then go out. But at the same time, you might miss some trades and you have to be happy to miss those trades, right? You can't miss this trade now and start getting FOMO and then, everything goes downhill. So your FOMO issues can't exist because sometimes you will miss a trade and you can't lose the plot because of that. Cool? Cool. So don't forget the homework, guys. This is going to be due before next week, Monday. If there is a date change for some reason, I will let you guys know. But by next week, Monday, we're going to be having the next session. So send this to me over the weekend before that Monday. And I'm
So,
going to
so,
review them.
sorry, just quick question.
Yeah, go on, bro.
You know that example you just showed, and you said it's a
hmm
valid setup.
hmm
The not the demand the demand zone above that was
Yeah,
there
yeah.
before.
This one, yeah.
Yeah, that's it. So there's a look. The gap is tiny, and obviously I know it doesn't really matter how tiny that gap is, right? And
hmm
because it's in front of the demand zone. But you're saying this setup is valid. Let's ignore the one below. Obviously, you don't like the setup because it's already been.
Yeah.
Yeah. So let's say this was like a normal day and that the previous one didn't happen. So you would
hmm
usually you mark out this demand zone, but wait for it to fill that
The
gap
gap
at the
below.
bottom there.
Yeah.
Okay. I didn't get that because I've gone through the A to Z
hmm
and obviously things like that wasn't
It wasn't there then. Yeah, yeah,
specific.
yeah.
Yeah, it wasn't mentioned specifically, but
Yeah,
it's good to
yeah,
understand.
yeah.
It's good to understand. So
Okay.
it's a good thing I didn't switch off.
Perfectly. That's
Yeah,
good.
thanks.
Yeah.
Appreciate
So
it.
these, yeah. So you're pretty much right. That's why I was saying that, for example, I might mention some stuff here that isn't in the A to Z, but it's not that what's in the A to Z isn't relevant because again, I wouldn't have won money here, but those that still took the trade would have won something, right? If you left at 1 to 1, break even, took partials, still a calm trade because I played out anyway. But in this case now, when price gets to this point and plays out, I'm not entering at this point, by the way, because it's too late. Price has already reacted, the buyer's already bought. I'm not now waiting for this and taking it again because price has reacted already. So let's remember that as well. At that point, this trade is invalid because price already reacted and started moving up anyway. Cool.
Okay.
So
Yeah.
can you show an example of price being filled, please? That could just be any setup, to be honest. So we can look at this, for example. I mean, this is at exactly 8 a.m., didn't win. But in this case, price filled the gap, right? This is the only gap present, price filled the gap, and then gave you a small entry right there. So this is an example of it being filled. So it's as simple as, right? Boom, got filled, gave you a small entry, and then went upwards. That's just price saying they don't want to sell no more. Can't do nothing about it. Asian session was done going downwards. Now London was pushing upwards.